Hello everyone, welcome to our webinar series. My name is Srinivas Kunte. I'm the Director for Professional Learning and Advocacy at CFA Institute. We have a slightly different kind of webinar today. It's on real estate, but not as in real estate that we buy, but real estate as an important asset class. We know that real estate is part of almost everybody's portfolio, but do we really treat the real estate component of our portfolio as an investment? And do we give it the same seriousness as we give to, let's say, the equities asset class? Our webinar today will really focus on this aspect. How can we look at realty as an investment outcome oriented sector? And we were scheduled to get a very good speaker, Mr. Sanjay Dutt, who heads the Tata Realty company. But unfortunately, Mr. Dutt couldn't make it as he's currently recovering from a viral fever. But to take us through the webinar today, we have got Mr. Bhavesh Madeka. He's been really very kind enough to step in. Bhavesh heads the business development and IR departments at Tata Realty. He's a veteran who has seen it all. He has nearly 4 decades of experience in the realty sector in Singapore as well as India. Bhavesh has led multi-million-dollar realty projects in Singapore, Malaysia, Australia, and of course, India. Previously, he has been the ex-head of finance for India operations at Ascendas-Singbridge. And he's also headed the business development function. He was the deputy head at Mapletree India Management Services. Bhavesh is a qualified chartered accountant, and he's also had training in general law from University of Mumbai. Thank you very much, Bhavesh, for joining us. Before I hand over things to Bhavesh, let me just quickly go through our housekeeping instructions. Many of you are familiar with them, but to recap, see, we have got about 1 hour, 45 minutes to 40 minutes of presentation from Bhavesh, followed by 15 to 20 minutes of Q&A. Try to ask, conceptual questions. Some of you have been very kind enough to in-source some of the questions, and I've passed them on to Bhavesh. With regard to asking questions live, try to use the Q&A box. Don't put them on the chat window. Use the Q&A box. Thirdly, the recorded version of this webinar will be available after the event as well in our website, and will soon, it will be there on the society website as well. And lastly, make sure that you give your feedback and what do you think about the webinar and how we could improve it. Do write to me as well. Now, without further ado, let me hand it over to Bhavesh. Bhavesh, a very warm welcome to you, and thanks again for stepping in. Over to you.
Thank you very much, Sridhar and Harshad, for giving me this opportunity to participate on this webinar. Well, I'm a step-in person for Sanjay Dutt, for whom I have a great respect, and I've worked with him and continue to work with him. He was my boss even in Ascendas-Singbridge. It's a topic which I've dealt with for about 20 years in my career of about 4 decades. And real estate is something which, I'm just getting a little philosophical here, that we have been involved since birth. Like when you're at home, you were born in a hospital, you go to a school, and a primary school, then you go to your colleges, secondary school, colleges. Thereafter, you go and work, study in universities. After that, you go and work in offices, and you go to shop around, or you travel, or you go for your office work to travel for office also and stay in hotels, or you work in factories or logistical warehousing areas effectively, and then we go to shop around in malls. So effectively, if you see it, we day in and day out live with real estate in some form or the other. And it is very personal to us if you really think about it. And as in real estate, they've always said, location, location, location counts. That was always the mantra for real estate. Now, suddenly, a COVID situation has happened, and it has actually, the pandemic has been brutal. It was equally brutal in 1920s. And today also, it has completely stopped the world in a different way. We are all working from home, and it has changed the whole mantra of working, and it has become the new normal. But let me step back and go back to 1920s to 2020, that it is actually transformational since 1920, when we had the first pandemic, which we all understand or are still aware about it, and there are some data points associated with it. And it has grown, actually, the real estate sector has still grown post that. Effectively, today, the medical facilities and the pharmaceutical industry is working towards vaccines and such other things, which is going to be transformational, which was not available in the 1920s. So therefore, I would first like to take on this topic and move you back to 2019 in a pre-pandemic situation as to for real estate in India, as to where we were. Let us go back to the basics about India and its economy, because that is also equally critical. Yes, there is a change, but let's not forget about 2019 and prior to that, and what we were looking for or moving towards. We were moving towards 40% of the Indian population by 2030 to move into cities. And cities would mean like 1 million plus populations. Today we have about 65 such cities, and that would grow up to 100 smart cities by 2030. That was what the government wanted. Plus, the median age of our working population was going to be around 31.4 years in 2030, which would be lower than US and China. So effectively, we would wanting to, the next factor is that for such a young population, we would require phenomenal amount of real estate. And therefore, the government was spending on the infrastructure side too, and it was relaxing the FDI norms. And as I said, the government wanted to build 100 smart cities. Now, where we were and what we wanted to achieve by 2030, all the estimates were talking about $1 trillion economy by 2030 from the real estate sector, with a CAGR of about 20%. Residential real estate, by 2030, it was supposed to be 2x in key cities. And we needed 25 million affordable homes in the urban areas. Commercial real estate was growing, and it was till 2019. And let me come back to all the policies which government implemented: demonetization, RERA, GST. And these were the reasons where the real estate and the IBC also, not to miss that, was impacting the residential real estate. But the commercial real estate was doing very well. And in 2019, we had developed and absorbed about 50 million square feet of office space. In light of this, further to add on to the impetus of the commercial real estate was the REIT structures, which some of you would be completely aware. In most of the advanced countries, a REIT structure is an institutionalized, with a lot of corporate governance, holding structure for commercial real estate. The investments which India received in 2019 was to the tune of $6.2 billion. Well, there were certain investment outlook for 2020, and I just want to share that nobody has anticipated a COVID, but the estimates were that we would achieve $6.5 billion, which we will not now in the current context of things. And what was growing in 2019? It was mainly commercial real estate. All the asset classes or the funds which were coming were from abroad, plus jointly invested by the foreign investors with the local investors, and purely by the local developers was only 8%, because they were actually hit by all the past of demonetization, RERA, GST, and the IBC codes, plus the NBFC crisis, if I were to add on to it. In light of this, so the major factor in 2019 was commercial real estate. And the second class, which was expanding very well in India, was the retail. It may sound a little odd to us today in a post-COVID situation, but that is really the fact that 19% of the asset class funding was to retail. And it was a very low 8% to residential. Going on to my next point, that we had developed about 4.35 billion square feet of residential space between 2009 and 2019, and against which 3.85 billion was absorbed. And therefore, there was a stock of approximately 0.5 billion square feet available for sale. But this stock also was not at its peak. Its peak was 2016, and it had come down in 2019 to about 858,000 units available. Next point, actually, I just wanted to make was that we had 250,000 units were launched in 2019, and that was also reducing because the residential developer community was fully aware of the challenges it was facing in the market and wanted to bring it down so that the demand increases and the supply reduces and effectively absorbs all the unsold stock. Today in 2019, we had about 30 months of stock, which should normally be about 20 months or less, and that would be an ideal market. Look at the next stage of facts in the 6 major cities. Effectively, the unsold inventory is very high in locations where there were investor class of people going into residential real estate. But where in the cities where it was owner occupied, which is mainly Bangalore, Chennai, Hyderabad, Pune, you realize that it is much lesser stock is available. And today, if you see compared in 2019, that we have literally in Hyderabad and in Bangalore, less than 2 years of stock available based on the absorption of 2019. The new launches also prove another point. What it is saying is that we are launching much lesser units than what actually was absorbed in 2019. It all justified the fact that the developer community was mindful of the unsold inventory. They did not want to take too much of exposure post all the changes which had happened to the real estate sector. And they were adjusting very well in 2019 to the dynamic economy play at work from a real estate perspective, and especially from a residential perspective. The office stock, on the other hand, in 2019 was 630, and by first half 20, it has reached 650 million square feet. We added about 40 to 50 million square feet, and most of that got absorbed. The vacancy levels were very low. However, today in the first half of 2020, post the pandemic, the absorption rates have dropped by 56% as we see it. But we still expect by the end of the year to achieve about 25 million square feet or thereabouts of leasing or absorption compared to 50 million square feet. Another point, and here I would like to link it up, that because there will be there are some of the participants I'm told are from abroad. What you are seeing abroad vis-a-vis with the Indian commercial real estate market, I would just like to do a distinction that we are in a business space market where most of our office space is in a business park, which is in 25 micro locations within the 6 major cities. And the rents are less than $1 per square foot. And that has remained for the last 20 years. And that is why our cost in the comparison to the IT outsourcing to US and Europe has been excellently well on two fronts. One was the space front and one was the talent front. We created a lot of talent because we have phenomenal number of graduates, and therefore all of these added up that we were continuously growing. And one of the estimates was that in the next 10 years, we would be to 1 billion square feet. Now, I just want to add on to this point that this is the commercial real estate which is owned by developers and leased out to third parties. This does not include the real estate owned, and which is a very large component. Let me say that the large IT corporates individually own sometimes more commercial real estate and business parks than even a developer. Today, with the REIT process, that process might change, and technology is doing very well on the stock markets. You all know it better. And therefore, I think there is no need for them to divest it, but a day will come, because I would like to take the experience of IBMs and others who have divested their real estate during difficult times. And therefore, when the technology companies want to expand and grow, may also divest at some point of time, and that would also become part of the commercial real estate market. And the 5 major companies have a phenomenal 200 million plus square feet of commercial real estate, which would include TCS, Infosys, Wipro, Tech Mahindra, L&T Infotech, and Cognizant. So those are the 5 or 6 major companies own such a large space, besides the smaller ones who would be also owning IT space in smaller parks of 100, 200,000 square feet. They have their own office buildings. So this is the kind of market we actually, just another fact point I would like to say, that about the whole of Asia took up about 65 to 70 million square feet of office space, and India was 50 million out of it. Although the rents are much higher, we are a $1 square foot space. So the need for commercial space was always there. Now, COVID happened. I just wanted to give these facts so that we link it up. And although the new normal has come in, and I'll be talking about that, but we should not miss the point of the growth and where India could be in future from a real estate perspective. Office real outlook now on the post-lockdown situation. The lockdowns happened, we moved to our homes and effectively started working from homes. I, for one, obviously had the opportunity to work from home, but had never done that till the lockdowns happened. And I'm actually, you could say it, I'm from the old genre who did it for the first time, but I had to cope with it and managed to do it. And I think a lot of everybody would be able to do it. That's a fact of the matter. But I would like to also point out the challenges which we are facing. At the same time, to consider it from in your analysis, that really does it work out to be all the time to work from home. So those are also the factors which you will need to consider. So let me come out with all the issues which have come out now. And firstly, so everybody moved to work from home, and we have shown a phenomenal, how would I say, acceptance of that process for males and females. And I would say this work from home concept is going to create a social change for women to participate in the labor workforce. You know, when they were the family way, most of the people, women moved out of the work, but now they will not, and they will continue to do that. And that's going to add to our productivities and give an opportunity a lot to the women workforce. And that is a phenomenal advantage to India. The second part was the offices were on a staggered basis, it's opening. The lockdowns were being opened and somewhere it was again the lockdowns were being created. So that is creating a challenge. But now work from home will happen with rotational shifts because of the employee needs. And we have read a lot of articles which are saying that we are postponing our staff to come back to office for till March or till June next year. And we are seeing that in our own parks. What we are seeing is that the service staff is all coming to offices because most of the offices still have their servers located in the offices. India has still not fully moved on to the cloud, and therefore the connectivity in the offices and the servers will continue to remain. So all our parks are actually functioning from day one. Although we were in lockdown, but the parks were allowed to work, and that has actually happened. So the service staff was fully allowed to work because they had to go there. The air conditioning equipment all was on because it had to be kept in a certain way. So next thing is that still till today, there is 3 to 5% of the workforce coming to office. But coming to the next associated point is, are the rents coming the way to the developers? Yes. The fact of the matter is 98% of the rents are coming. And associated with it is whether the tenants are continuing to lease the office space. And if the leases are happening, are they giving us the escalations or a growth in the rental? Today, only an article came that 3.5 million square feet leases have happened in the first half. And actually, the leases are continuing to happen, but nobody's speaking about the rent escalations because maybe they are continuing at the old rentals from a perspective just to hold on, because the companies are also taking time to make their decisions. The pandemic has completely changed the outlook and has created a new normal. And therefore, most of the decisions are going back to the head offices, whether it is in US, Europe, or within India, or in ASEAN countries. So effectively, people are not able to make the decisions whether they would like to expand and continue, or they should cut down the office space. Related to that, in India, is another factor is, are the people able to work from home? Although we have showed that in the last 6 months and 9 months and the productivity is there. But do we have large homes like in US? The average home size is roughly about 2,000 square feet. Whereas in China, from a statistics which I've read, is about 750 square feet. And the average home size in India is about 400 square feet. Now, looking at that, does it make sense for work from home? For the aspirational and the younger generation in the age of 20 to 40, it is very critical for them to come to office for learning and development, to create the network, and to be able to rise in the scheme of things when you already know the people and you learn very quickly when you are together rather than to do on a call. On a work from home Microsoft Team call or a Zoom call or a WebEx call, it's only a one-to-one. So effectively, you do not get the time to interact as a group, and you have to speak one at a time. Whereas in a group, you want to listen, you will go and participate or move on and do some things which you like. Here you do not have the flexibility. So it's got more structured in a certain way. However, it's removed the flexibility and the networking part. And one of the facts is that the camaraderie had already been built between the staff members, and therefore they have been able to work. What to talk about the new employees who come into the system and whether they will be able to work from home. So these are all the factors which really pushes the companies to decide whether they will be able to retain talent, continue with their talent, because that is a key thing from an IT perspective and the technology perspective, or R&D, BPOs, BPMs, or even the AI and the data analytics part of it. So when you see it, which is the focal point for the commercial real estate, we need to see which are the key drivers to it. And when you understand that these are the drivers, there is a lot of understanding which needs to be there regarding the Indian real estate. I understand that the REITs are not doing that well in US, but they are mainly for commercial real estate. If you talk about Manhattan, where the rents are at least about $10 plus, and therefore the impact is going to be huge. Whereas in India, our office space is equivalent to a logistics or industrial space requirement, which they are paying to us. So please understand the real estate market in the true context of things in your analysis is my suggestion. New market entrants will be much more careful. It's going to be more corporatized, institutionalized. New supply will also be deferred. People are not just going to come out with real estate, because in the commercial real estate market, it is restricted to 8 or 10 large players in India. And at most, the number would not be more than 30 commercial real estate large players. The leasing in India happens in the region of 100,000 square feet to 500,000 square feet, which is not your usual case abroad. So to have this large kind of space and it being serviced well, you really require a large institutionalized with good corporate governance players to manage all your requirements. The last thing is the staff is going to demand a phenomenal amount of wellness quotient, and a health quotient is going to come into these things. Previously, the office space was it was shrinking. Originally, it was 100 square foot per person, had come down to literally 60 square foot. And now people are talking about that we need to go back to 125 square feet per person. If that were to really happen, the demand for office space is going to increase only in future. And in light of all these things, even if the work from home happens and 50% of the staff do work from home, what's going to happen is that you will have Monday, Wednesday, Friday, the other team members come on Tuesday, Thursday, Saturday, and work it out such that the teams can work together. So these options are going to work out, pan out over a period of time, but a change has definitely happened, and we cannot deny it, that the work from home is here to stay. Just to let you know that we have seen that happening in large corporations like IBM, where about 20% of their staff was previously working from home, but now more and more will do. In most of the other corporates, it was not to that an extent. They were giving that flexibility to work, which I also had it, but never used it. And similarly, now more people will use it, and that's going to be there. But we should be mindful of all the other needs of the team members and whether they satisfy it and whether it will grow. Because I would then go back to 1920s, and did real estate grow over time? It did, and I feel that it will continue to grow. But the optionality of work from home will continue to be there. In office space, what is the impact? The transactions have stalled, as I earlier said. The decision-making process is gone back to the head offices. Previously, the regional offices and the businesses used to take that decision. Now it is completely stalled because the guidance is coming from the top because of the new normal. In the retail, yes, the collapse of discretionary retail has really gone. We ourselves want to go to the mall but can't go, and we are very careful about it and fully understandable. But the online shopping and all that is still happening. And the warehousing and the industrial place from a geopolitical perspective will continue to happen for India in the current context of things from a manufacturing base and a logistics base. So that is going to grow. but the retail space may grow down, may come down. And actually, the agricultural bill, which was just passed recently, will also impact a phenomenal amount of cold storage space in logistics and such other things for the growth of India and for the growth of the mall culture and the retail culture, which is going to be very impactful. I feel the cold storage and residential will be a key driver in a sense of, because in India, consumer price index, the farm produce is a key component of it. And if we are able to store it well, our inflation might be stagnant or stabilize it. Because in peak times, you sell at 10 rupees a kg. I'm just giving an example of potato, and it can go up to 40 rupees. But if it is stabilized at 25, actually everybody makes the profit and it still can work out. Going next to the residential section, launches have got delayed. As I showed you, even in 2019, that was happening. And the demand for space is increasing for bigger units. People are going to be mindful that if they were planning to take a 1-bedroom unit, are moving towards 2 bedrooms and 3 bedrooms. So let us be mindful that the space requirement is going to increase. People are going to be more careful in making that decision. But two things have changed. People want to move out of rental deals and move into their own houses. One, they want to move into bigger space. And what is going to help them, in my mind, is the capital structure. The interest rates are coming down drastically. The repo rates have come down. And therefore, its impact is going to come onto the residential loan rates, which has actually come down to about 7 or sub 7. However, the rental yields are not there. And therefore, the rental yields need to rise such that it stabilizes and we become markets like Singapore or US, where the rental yields are like 4% and the interest rates are 2%. But because in India, everybody expects an inflation and an increase in the capital values and do not consider the yield. And therefore, the investor class has completely got wiped out in the last 3 or 4 years in the Indian residential real estate. Same thing has worked excellently well for the commercial real estate because the yields are much higher and the cap rates are coming down and the 10-year treasury bond rates are coming down. And therefore, the REIT yields of sub 7% are acceptable to the 2 REITs which have happened in India. Although the first REIT in India has happened for Indian assets in Singapore as called as AI Trust. So effectively, the commercial yields were better and therefore they were doing better. With the interest rate coming down, their cap rates and yields have really come down, and REIT as a market is going to expand. We feel that out of the 650 million square feet of office space, 400 million to 500 million square feet can move into REIT structures over time. Lastly, investment. Yes, the investment is happening. There's a phenomenal amount of money play due to the QE aspect of it. The interest rates have come down or become negative in Western world. In the Indian context of institutional play, it is the pension funds and insurance funds, which have not seen a REIT kind of a structure in India, are getting used to it. And in the long run, they will constitute a large part of the REIT market and funding and the investors into it. The social implications and the changes in the behavior. As I've said, owner versus tenant comfort in these times, that is actually happening. The next thing in the residential sector, which is changing, is that people are gravitating towards large corporate developers who will be compliant, follow the RERA regulations, and will deliver it on time is the crucial aspect. because we have seen a lot of developers not committing to pre-RERA projects, still not delivered, and needs to go into the IBC process, and the courts have to come into play to achieve or to at least develop it and close out the projects. So and today what is happening in the residential market in a different way is that people are going for ready to move in units, means it's completed, OC is achieved, and you can move in tomorrow. So those units are the better ones to buy in from a perspective of a residential investor. And the stock is actually coming down of completed units. The launches are lesser, so therefore that is happening. And today also we still have, how I would say is that it is reorganizing itself or consolidating itself into large corporate players. And it will definitely succeed over time, as it has actually happened in the commercial real estate market. Worldwide, real estate was managed by limited players. It was only in India that we had, like in my another slide, you will see that we have literally like 5,000 developers in the market. But all that needs to consolidate and organize to the new normal, and based on the laws, plus the new normal of COVID, and work their way through. Work from home is not just for co-working, but for every other lifestyle. And as I said, it is going to transform, but I still feel that the 20 to 40 age group, for their aspirations and to grow, and for learning and development purposes, will want to come back to office. How is the recovery going to be? And that's the critical answer which everybody wants to know. We all feel that there's a disruption going to happen. It will continue till 2022. Which are the sectors which will do well? Office, warehousing, and retail might have an hockey stick kind of a recovery, whereas residential, purely because of the amount of stock in the market, might be a U-shaped recovery. And it might take slightly longer because the stock levels need to come down. Today, the people are a little scared to buy units, despite, like in Maharashtra, they have given a reduction in stamp duty, is the fear of their jobs and fear of continuity. Despite interest rates coming down, stamp duty lower, developers are willing to give the discounts, but the factor of job and their security is holding them back to buy it. People have moved back with their parents, people have moved back to their hometowns, but over time that will also change over time, slowly and gradually. And therefore we feel that the disruption might be longer in the residential sector. But what we need to also see is how the consumer spending comes up over the next 1 or 2 years. Auto sales, interest rates continue to go down, lending, because that is also a key factor in our market, because the banking sector and the NBFC sector were going through the large NPAs and its impact on the markets per se. The 10-year treasury bonds are hovering around 6%. And at the same time in US, your 30-year bonds or 30-year home loan rates are coming down. It's a very contrasting things which are happening in different markets, but it is happening due to the facts of each market or the dynamics of each market and where they are playing. And that needs to be studied for each market. In India, so the NBFCs and banks which have an exposure to the developers is going to be a crucial factor. And as we said, the debt levels of the country and the banks and all is going to increase only, but how are they going to repay over a period of time? And that is crucial. And therefore, large corporate players and institutional players may come into the market, and therefore then they will be able to stabilize the yield, the interest rate component, and the return expectations. The return expectations of the equity capital players is going to be quite huge, and expectations will be much more than your usual. But whether they will be able to achieve it is another factor. Coming to the REIT overview. REIT started in USA in 1960, but that was the first REIT which happened. And actually the second REIT happened after literally 20 or 30 years in US. I'm not sure whether it was 20 or 30 years. Japan started in 2000, Singapore in 1999, and UK in 2007. But see the market capitalization of these REITs in 2018. It was quite high. I understand that it has impacted a lot. But what I wanted to show from a Singapore perspective, that when it started in 2002 and the same REITs, how much stock they were holding over a period of time. From 636 million for Ascendas REIT in 2002, it was $10.44 billion dollars of REIT capitalization with 171 properties. In Capitaland, it moved from 7 to 10 and from 580 million to 7.9 billion. In Mapletree, it moved from 3 to 5 and from 1.5 billion to 7.2 billion. And in Mapletree Logistic REIT, from 422 million, it moved to 8 billion, from 15 to 141 properties. So you can understand that equally, India has a big role to play in its REIT market. And that's something definitely to grow, especially because if you want cheaper capital and if you want cheaper funding, which are both easily available for good assets, good sponsors, and for good corporate governance. These are the three critical criteria for REIT to succeed. And this has actually happened in all of the 4 countries I mentioned above. And therefore, if we follow that path, it will equally happen in India too. The 2 listings which have happened, first is the Embassy Office REIT. They raised 47.5 billion rupees. Mindspace raised 45 billion rupees. And the timing of Mindspace speaks a lot about the REIT market. It happened amidst the COVID, and still it achieved a premium of 10%. The IB banker, you should give them a great congratulations, because they managed to get a 10% rise over the market, which is a fair thing. I would say that when you get, after listing it, if the rates are more than 20, 25 to 50% increase in pricing, you could blame upon the IB that he didn't do a great job. But effectively in Mindspace, it was excellent that it achieved a 15% growth post-listing, which is a fair one. And here, the Indian pension funds and the Indian insurance funds also participated. This was for the first time. In Embassy REIT, they had not participated. Most of them were effectively foreign institutional players who understood the REIT market. The next one, which is going to come, and it is already announced in the newspapers, is Brookfield, which is also going to be a large one, from either 40 to 55 billion rupees. And they have already, there are news in the market, they're acquiring a portfolio of another 12,500 crores from a developer in Bangalore. So all this leads to the fact that the REIT market in India is there to grow post-COVID, considering the phenomenal amount of liquidity post-QE, post the low or negative interest rates abroad, stabilization of the Indian rupee, and to say onto that fact that we had about $475 billion worth of reserves in March 20, which has increased to $540 billion in August 2020. During the COVID period, rupee has marginally appreciated. So all factors put together shows that actually the REIT market is here to grow. The yields are coming down, because even today the yields are in the region of about 6.75% for Embassy and Mindspace, 6.75 to 7%. And they are able to borrow from the market, from the banks, which previously was only based on lease rent discounting at 9% or thereabouts. The REITs are able to borrow in the region of about 7 to 7.5%, which is totally an unexpected outcome. There is a reason for that, that they are unable to borrow more than 50% of the market cap or the market cap of the REIT. So effectively they are restricted, and the bankers are confident that they will be able to raise the capital if they had a capital call or raised a rights issue. So effectively, we feel that the 7 cities in India will transfer most of their commercial real estate will go into REITs in the next 10 years' time. But I would also like to say the other asset classes, which is the malls, the hotel, hospitality, service apartments, hotels, and hospitality real estate will move into REIT structures. The next thing will be the logistics and industrial space. And lastly, but not the least, we do not have it as yet, is student accommodation. We have it on the campuses, and a day might come when they may move into REIT assets. Finally, residential REITs will also happen by about 2035, when the yields in India for residential real estate increases and the interest rates come down. So that is the factor associated that REIT as a market is there to grow in different asset classes, despite we are seeing that in a COVID situation. And let me tell you that in Singapore, the first REIT was listed when it went through in 1998, the Asian financial crisis happened. The first REIT happened in Singapore at an 8% yield, and which was done by Capital Land. So when you see that, the same philosophy is going to apply to all of us, even here. I would now take you to the post-COVID trend on the residential real estate, that from 5,692 developers, it is shrunk to 2,670 developers in 2017, and I still feel that it will further come down. This presentation is going to be shared with you, and I'll just try to finish it soon. The technology and the wellness aspect, we all want it. We may already be using it in some form or the other, even in our residential societies, but we will be demanding more on all of these fronts going forward. The impact, I've indirectly covered most of these points in my previous slides, or I've spoken about it in some form or the other. And I would like to say that the winners and the losers, everybody understands this. Co-working, travel and tourism, I meant to say hotel. General retail is the malls. Senior housing and education will be impacted. The reason for senior housing is that they would want to stay with their family, with the children, rather than stay in a senior housing place in times of COVID. So that is why they would be impacted. But the data centers and warehouses and logistics and industrial is going to do great in India going forward, to one of the factors being geopolitical reasons. Thank you for your patient listening, and I'm here to take the questions, if any.
Thank you very much, Bhavesh. The presentation was really very insightful, and I've got some questions on the board. There are other questions also that have come up separately via email. Just help me understand, and you've covered it in the presentation, but can you recap? As an investment asset class, we've got, we could invest in property, like real property, physical property. We could go to REITs, we could go to stocks. Am I missing anything? Okay. Is there land?
What happens is actually, yeah, you could invest in land,
okay,
things, but if we are talking from an India perspective, let me be very,
Yes.
you have the issue of encroachment. So you need to be careful where you're buying the land. If you're
Right.
buying a gated community, you're fine. But otherwise it's a challenge, one. The
Right.
second part is if you're buying a REIT, compared to you buying an office space, because starter office space has been sold a lot. Commercial office space, a lot of us have been sold as starter office space. But then you need to go and lease it out. However, if you do it through the REIT structure, and if the corporate governance is good and the sponsor is good, you're going to have a yield and a growth aspect to it, including the valuation aspects to it, which will come your way over time, and you are effectively covered. Now, on the other half of the stocks, what's going to happen is there is two aspects to the yield. One is a development yield, because it takes the risk of buying the land, getting the approvals, after that leasing it out. I'm just saying that. So all these three aspects are development yield, and you want to achieve a 20% yield. But the sponsor or the developer would want to pass it on to the REIT, and that is the flow of the capital flow, where the banks and the NBFCs will be avoided in future. Because if the developer has this circle, that means he buys the land, develops it, and sells it to the REIT, he gets back his capital, and he circulates within himself, then he becomes very strong and stable. And that's actually happened all over the world. And that would equally happen in India. So from an investor perspective, the developer entity is going to make higher yields, but that would be a listed developer, whether it is doing residential because that is for sale, or it is doing commercial real estate, which is also for sale. But a completed property, a leased property, the risk is lower and the yield has to be lower. You cannot be, then the pension funds and institutional players come. And it is more of the mom and pop monies, which is more for the retirees and such other parties who would definitely want to invest into that real estate. However, if you want to have for your own office space, then it's a different matter that you may want to go for starter sale office. But you cannot get a good quality office in that sense of it, because most of these REITed properties are maintained very well and they cope up with all aspects of it, including these kind of COVID situations where their properties are available in absolutely conditions for the tenants to come. Even during the lockdown, they were allowed to come. So it tells you a lot about how it is managed.
So one of the main complaints people have is the low yields in India, and I'm not sure to what extent that applies to commercial real estate. But so please throw some light on that. But if the yield problem actually goes to the REITs, then REITs also becomes a problem. What is the root of this low yields in India? Why do we have low yields?
The low yield is only in the residential real estate. Let me clarify. That is only 2 or 3%. Actually, your yields in residential. But in the commercial, the yields are actually, development yields are about 12 to 15%. Let me clarify that. But you need large players in that. It is not an individual play. Let me clarify that. The developer is selling to you a starter sold property, then you are buying it and then you are trying to rent it. Then you're going to get the other factor was prior to demonetization, people were buying commercial real estate, which no longer holds good today. So that is a big change. But effectively, if you're talking from a bond, see, compared to a bond, it's a 10-year bond, which gives you a 6% yield, and a long-term, fully owned freehold property is giving you a 7% yield, but the rent escalations and the growth of the market will give you a phenomenal better yield it gives you a return of about 11 to 13% for investors in the REIT assets. So actually on an annualized basis, it's about 12 to 13%.
Right. So I just wanted to quickly, because Kalpit, one of our members, he has been asking this question. What is the core of, why are yields low in India in the residential real estate? Is it because of black money? Is it what's the main reason? What are the drivers there?
Previously, what you said was right. I don't want to state that, but actually that was the factor. Because it was a cleaning up of process, actually, kind of thing. And therefore the yields did not matter.
Okay.
Cleaning up act. However, now that cleaning up act is no longer there. And therefore, if the real estate, the developers are going to shrink. See, right. It's a gradual process. It's going to take about next 2 to 5 years, in my view.
Right.
It's going to take about 5 years to stabilize, where the developers will not be bringing out so much of inventory in the market. Automatically, the rental yields will go up.
Right.
Interest rates are coming down.
Right.
And the time is going to change. And I think that will be in the region of 2023 to 2025. This transformation is going to happen.
Right. So in the listed space, we've got the real estate stocks and we've got the REITs. How should investment decision makers look at these two structures as a potential for investment? I do note that the stocks have not done well at all. In fact, I was from publicly available information, I think they've been flat for the last 5 years.
And the reason is purely because of it's the exposure to the residential real estate.
Okay.
Commercial part. See, commercial part, I'm just taking an example of DLF. DLF was able to monetize a substantial portion of their portfolio of DAL with the family, and the DAL portfolio was owned partly by the DLF company. And so it did amazingly well on that portfolio. It was in fact able to pass on the monies to the promoters and who injected it back into the company, and it is now very stable or strong in the sense that they have been able to repay the debts. I'm just giving an example, I mean, based on the public information which I have. And therefore, residential real estate has not done well because, as I said, demonetization, RERA, GST, IBC, NBFC crisis all put together.
Right.
And what is happening is the poor developers, the fully, how do I say, levered developers are actually bringing down the price, and therefore a corporate developer can't hold on the price. Whereas in commercial real estate, the ability to hold is way higher because of the institutional investors. And an insurance fund is happy with a 7% yield plus a 5% growth factor. So it becomes a 12-13% IRR to him. They're happy with it.
Right. So one of our members, Sandeep Gupta, he's done a lot of real estate himself. So he makes a point, what is your view on direct fractional plays? Do you know about prop share or strata prop? Because REITs are more like MFs, right? Do you agree with that? Are they more like mutual funds?
No, they have recently started actually. In India also it has started actually, kind of thing. And I think that is going to work well, provided the sponsor is good and corporate governance levels are right. These two are the critical factors in any real estate deal.
Right.
You see, the whole process is the same. It is land acquisition, approvals, development, sale, or lease. So all these four aspects are constant. You can't change it. How are you going to do it? Just tell me that. Means effectively this thing continues. Once you have leased it, then you have to manage it, and leasing has to continue. If you're the owner of the property, whether you are able to do it, you do it through the REIT way, or the corporate governance has to be at its highest.
Right. Now, on coming back to the commercial real estate, now you clearly kind of pointed out that there's a good and a bad in the Indian real estate space, and I'm not saying necessarily bad, but we've got on the commercial side we've got institutional players backing, so and to that extent the governance etc. is better. Now in the commercial space in the REITs, you pointed out 3 nice graphs where you showed recovery rates, and you've nicely argued as to why people may want to go back to commercial spaces again. But is there some uncertainty? Do you think there is there'll be some shrinkage in terms of the net commercial real estate that would be required for offices in the future, let's say 20 years down the line? I know it's a very, very long call, but what is your view? What is your thinking? How do you think about it?
See, here, actually, we should not forget that we are an emerging economy with 2,300 per capita, right? See, not lose out the facts of the growth. Okay, our multiplier is 3.5 on a PPP. So we are like at about 8,000 or 9,000 or $10,000 per capita, or 6,000 or 8,000, $10 trillion economy, sorry. So effectively, we should understand that we are a growing economy. We are giving all this. And I just want to say some of the things which I personally have experienced it. People work in the park because most of the IT graduates which have come out are staying as a paying guest. He's cooped up in his home. The park is an open space requirement, open space which gives him phenomenal flexibility. There are cricket grounds on the park. There are sports facilities on the park. There are friends on the park. There are every entertainment, all outlets available in and around that vicinity. It's a great place to mingle, to learn, and to experience that. And that is why the movement was happening. You see, the tier 2 and 3 cities never grew in the past. Actually, it was only the major cities. But the micro centers started coming. In Bangalore also, which is the largest one, you have 3-4 micro centers in Bangalore. You have Whitefield, you have Sarjapur, you have South Bangalore. Today, the North Bangalore is getting developed in a big way. So effectively, these and Yashwantpur and all that. So you have 5-6 micro city centers, and they all grow very well. And because you wanted the people to come together and to learn together. Now, this kind of an environment is not available to him at home or anywhere around his place. And therefore, he is happy working in the park.
Right. So one of our members from Bangalore, Kirtan Mehta, he's asking if you were to look at REITs, and he's a senior member, he's an analyst himself. If you are looking at REITs, what are the 3, 4, 5 different things as an investor should look at? You mentioned corporate governance. So what are the other 2, 3 critical things that people should look at?
The sponsor, the developer, and how much, he has a growth pipeline, because normally in this REITs, the sponsors give a commitment that their future developments, they are going to pass it on to the REIT, because the growth is a critical aspect of it.
Right.
It does not have 50% leverage. They can give up to 50% leverage and go on buying these assets. The leverage rates are lower, and if they can buy it or the yields are lower, effectively they get a good growth potential associated with it. Further, in the Indian leases, they are long-term leases, most of them. So therefore, and an escalation clause is built in between 12 to 15%. People are now talking post-COVID, people are just going to be a little careful of negotiating it. But here we are still talking of less than $1. For the IT companies, 60% of their workforce, their cost of is the workforce cost.
Right.
It constitutes hardly 10%. So it's not going to be a big deal. The margins are 25 to 30%. So I feel that, everybody wants to negotiate and extract their pound of flesh, but in reality, there's not much flesh left in this. And that growth is a very stable growth, which should be given to the real estate developer because he's taking a big risk. Lastly, but not the least, which people miss out, that tenants have to do fit outs. See, the cost of fit outs is in the region of 2,000 to 5,000 rupees, depending on if you're a captive, like Goldman Sachs captive would be having a very high fit out costs and all that. I'm just saying for MNC large banks. Right. Now, they will not be wanting to move out because they have to write it off over 10 years. So the factor is that it is holding them back to move out into another office space or to negotiate, because they will lose out on the fit outs. Imagine if you have done a fit out of your own office at 5,000 rupees a square foot, would you want to let go of it in less than 10 years time?
Right. Neeraj Gupta, he's wanting to understand your view on, you mentioned about unabsorbed real estate, and you've given the peak, and you've given the quantum of unabsorbed real estate as well. How do you see the cycle playing out? A quick answer, because we are running out of time.
Okay. Yeah. The quick answer is that India has a phenomenal advantage vis-a-vis the talent pool and all that.
Right.
Where are you going to put them? And actually, still the laws have still not come into India. In India, residences are being used as offices.
Right.
The law comes that the residential place cannot be used as office, commercial space.
Right.
The amount of people which will need to move into commercial space. So commercial or IT space or whatever you call it. Indira Nagar in Bangalore is a big example. It was a completely residential place, has become more commercial in nature.
Right.
That happened.
Yeah.
In other countries, that doesn't happen.
Right.
You live abroad, you understand it. Each county will say, this is my location. Gurgaon is an apt example. And therefore, Gurgaon does very well in that aspect of it. And DLF Unitex and all the other developers have done very well there. Because there it is restricted. Residence is residential, and that, the sectors have that quotas.
Two last questions. Any quick views? Jaideep Bafna is asking, any quick views on warehouses? What's the supply demand and how should we think about it? That's number one. And lastly, what is your sense of, have the Indian property developers adopted the latest technology? I still see, real estate projects lingering on for, if not months, years, if not years, months together. So I'm sorry, these are probably long answers, but see, if,
One question is that on the question of logistics and industrial, I feel
yeah.
definitely the demand is quite good and it's going to play out. However, just on the logistics play, I just also want to caution that we are just 15% of ours is manufacturing, whereas China is 50%. So we can't compare it to China at any point of time because the GDP, the constitution of GDP is like 15 to 50%. It's quite high in China, and therefore logistics does very well in China or Singapore because they are port city or something like that.
Right.
So we can't be taking that factor into India. However, the agricultural part is going to play a big role in logistic. If the India's GDP on manufacturing grows from 15 to 25 because of the geopolitical play, I think that will be a great one for logistics further. But logistics play is definitely changing. People are going into organized play. It is exactly like the IT park that people want to be in an IT park, and slowly it is going to grow. So I'm quite confident on logistics and industrial is going to do well over time. The rents are going to increase. They've started with like 12 rupees and gone up to 18, 20, but I think definitely it will do, industrial will do really well over time. Sorry, if you can just recollect the second question.
Yeah, I mean, how agile are we in adopting the latest technologies?
Okay, as far as in the office part of it, actually, of maintenance of offices and all that, we are doing very well. Actually, we are equivalent to foreign countries like Singapore and all that, and touchless technology and all that is coming into India. We are implementing it, and all the latest technologies are definitely coming into India, like VRV and all that is going to come. Now, India is a cost-conscious country because India proves itself that I want to sell, basically you're exporting software. So you want to keep your cost up. That is the restriction. It is not if you ask the community that you're willing to pay in a BKC location where people are willing to pay 300 or 350 rupees, you can have a raised floor kind of a thing, which is there in a commercial office space. And you could have your connectivity below your, below your table and all that. You will have air conditioning only suited to you. You can have all of these provided you're just willing to pay that price. Our rents, you want to keep it at $1 and then expect, so technology has a cost to it, and therefore you need to pay for it. It's not, Indian developers not willing to bring it. They are very keen to bring it to the market and expand it, but it's a question of balancing out.
Right.
Till the ability to pay comes up.
No, that's very insightful. I just wanted to tell participants and remind them that we've got an important conference coming up. It's a FinTech conference. It's on October 2nd and 3rd. If you have not registered, please do register. We have got amazing speakers in that conference as well. But coming back to Bhavesh, thank you so very much for your time. Thank you so very much for stepping in at the last moment. I believe that it was a very insightful webinar for all of us. And we hope to see you again. Thank you all for joining in today.
Thank you for giving me an opportunity to participate with CFAI team members, and always wanted to do CFA after my CFA, but back off from it actually after doing CA and going through the challenge. But effectively, I would wish all the best to all the participants who have joined on this thing.
Bhavesh, it's never too late. Maybe I can approach you later on. So anyways, thank you very much.
Yeah, learning is never, at any point of time you can learn. I agree with you. I agree.
Thanks a lot. Thanks a lot, Bhavesh.
Thank you very much. Thank you.
Bye-bye.
Copyright 2020. All rights reserved. This program is designed to give accurate and authoritative information in regards to the subject matter covered. It is distributed with the understanding that CFA Institute is not engaged in rendering legal, accounting, tax, investment, or other expert advice. If legal advice or other expert assistance is required, the services of a competent professional should be sought.